Hi, welcome back. My name's Tom. You'll probably know me better as the Kaizen Trader on Instagram, Twitter and in ASFX. So if you're new to this channel, welcome. Thank you for watching. And in this video, I'm going to go over Monte Carlo simulations and how I use data to help me position size into trades, manage my emotions, to help me manage drawdowns and the expectations around winners and losers. What is a Monte Carlo simulation? And what I'll be doing here is I'll just read the Investopedia definition and then I'll try and relate it back to how it relates to trading. Monte Carlo simulations are used to model the probability of different outcomes in a process that cannot easily be predicted due to the intervention of random variables. So what this is saying is we are going to be using numbers and maths to try and predict the outcome of something happening based on random events. And in this situation, the random variable is our trading plan in the form of winners and losers. We have no control over when them winners or losers are going to occur. So we'll have a certain amount of losers in a row, a certain amount of winners, but over a large enough set of data, they will be able to be accurately forecasted on the outcome. It's a technique used to understand the impact of risk and uncertainty in prediction and forecasting models. So like I've just said, we're going to be using this to understand what the impact is of a specific win rate. So 50% win rate, for example, what are the order that we can expect to take winners and losers in over a large set of data? More importantly, what would be our largest losing streak or our largest winning streak, which will then enable us to be able to position size correctly to withstand adequate drawdowns. So here on screen you'll see this is a Excel spreadsheet which I have made. It's to help me run Monte Carlo simulations for win rates, and what I'm trying to do and identify is what is the largest number of consecutive wins and the largest number of consecutive losses. And I'm more focused on the consecutive losses because what I want to determine is my position size based on my strike rate, so I can limit my drawdown but then maximize my returns. So I'll show you what this Monte Carlo simulation is going to do and how it works to give you a better understanding of how we end up with this result at the end. Here in this random number, this is a number between 0 and 1 and it is completely random. So Excel produces these. Every time a click is made into the page, a random number is generated. And what we're trying to do is we're trying to determine whether that number is higher or lower than the percentage in this box. And if it is higher, so 70% expressed as a number is 0.7. So 0.73 is higher than 0.7. So we are saying that anything above 70, which should happen 30% of the time because my win rate percentage is expressed out of 1. So 70%, anything above that falls into the losing category, and you can see that is given a 1 in this column. And every time it is lower than 0.7 or 70%, we get a 1 in the win column. And then these columns here, these are just counting the consecutive numbers of wins or losses. And then when we have the other one occur, it resets and goes back to 0. So I'll just quickly take you through the first 3 or 4 and when you get the idea, and then I'll show you how many rows this goes down. So for the first one, the number is 73, which falls into the 30% of as a loser. So we get a 1 in the loss, and it represents our first consecutive loss. The next number is 0.47, which is lower than 0.7. So that then reflects as a win. So we get a 1 against the win column. And you'll see here that now we've got 1 consecutive win and the losses has reset. Now we go again to the third entry. Again, this is higher than 0.7. So we get it next to the loss, and we get our first consecutive loss. And then you can see for the next two in a row, they are both higher than the 0.7. So we've got 0.89, 0.81. So you can see here that our consecutive loss goes from 0 to 1 to 2 to 3, as we have three numbers above that 0.7. So just remember that anything higher than the 0.7 is a loss, anything lower is a win, because we're saying that 70% of the time this number will be less than 0.7. Now, as you can see, this goes down to my bottom of the spreadsheet 100,000 times, and then it's got my total, so how many winners out of the 100,000 and how many losers. And then what this does here is it tells us our maximum consecutive wins and our maximum consecutive losses in this 100,000 set. And what I am then doing here, each 100,000 trades is this table here. What I'm going to do is, if I click this Run 20 Simulations button, that is going to run 20 simulations of 100,000 trades. So what we're saying is these random numbers are our random trade outcomes based on our win rate. So we have no control over these numbers, and we have no control over our winners and losers in the market. But what we're saying is, if we have a system or a strategy that wins 70% of the time, this is, based on 100,000 trades, a period of what you will get in terms of consecutive wins or consecutive losses. And this is as a guide. So I'm going to click this button now, and it will take us through 20 simulations, and then we can just start to look at the data that is collected. So now you can see that all of these have updated, and what it's done is copied these, the total wins, the total losses, the consecutive wins, into each one of these 20 times. So you can see here that the percentage on that last run was a 69.96% win rate against the 70% that we're aiming for. And you can see here that the maximum on one of the runs, so on the 12th run, we had 42 consecutive wins in a row based on a 70% win rate. But on average, over the 20, we've had 30 consecutive wins in a row. But the bit that is important in this scenario for me, and when I look at my trading and my position sizing against my back testing, if I know I have a strategy that wins 70% of the time, I know at some point I can and will, if I trade it for a long enough period of time, have 11 losers in a row. So the question I'm asking myself is, if I was to risk 1% each time and I have 11 losers in a row, am I happy that I can withstand 11 losers in a row from a mental capacity, from a capital perspective? So what I'm going to do now is I'm just going to show you some examples of some more simulations, just to really show the effect of these Monte Carlo simulations and large data and what you can expect when trading. So if I go to 50% now and I run 20 simulations, so you can see here that things are a lot more even than they were with the 70%. So at a 50% win rate, you can see here we've had 21 winners in a row, and we've had 19 losers in a row several times. So this is quite a common occurrence. What we need to do is we need to make sure that we can withstand up to 20 losers, 21 losers really, in a row on a 50% win rate. If I just run another one at say 30%, but just for demonstration purposes, I'll show you the amount of losses that you will have if you have a 30% win rate. So as you can see here, at one point during one of these simulations, there was 36 losers in a row with a 30% win rate. So we need to make sure that we can withstand, from an emotional and a capital perspective, up to 36 losing trades in a row with a 30% win rate. So I'm just going to go the other end of the scale now and go to 90%. With 90% win rate, you will lose up to, as a guide, 6 losses in a row. We need to be prepared to have up to 6 losses in a row. Got to really think about the numbers and how this position sizing is going to help moving forward. Thank you for watching, and hopefully you have found some value in today's video. What I will do is I will put on screen a view of all of the win rates and the largest number of consecutive wins and losses based on these 20 simulations run 100,000 times for you to sort of print off or share or keep on your desktop for you to look at. So when you are back testing or when you're trying to make a risk management strategy, you can bear in mind the amount of consecutive losers that you have in a row so that you can size appropriately from your capital perspective and a emotional capital perspective. So thank you, thanks for watching, and I look forward to seeing you all again soon.